Welcome everyone. I'm Srinivas Kunte, Director for Professional Learning and Advocacy at CFA Institute. I'll be moderating today's session. Thank you very much for the overwhelming response to our webinar series and particularly for today's session. It is understandable given that hedge funds are considered by many, if not all, as the holy grail of investing. I don't know if you have taken a look at Ray Dalio's latest blog on 13,000 word blog on LinkedIn. He's put out enormous risks that the world is facing today. Our own Kuntal Shah, I think last week, Wednesday, he highlighted the unknown and some of the known unknowns and also, the risk that the uncertainty that is associated with unknown unknowns. But despite all of this, there are some smart people who are making money. Take a look at Taleb's performance. As Barton Briggs probably in his book Hedgehogging said, there are gods who predict the future. There are human beings who can look at the present, and there are hedge fund managers who can act on what's happening, what's going to happen now. So we've got a very good speaker today, Supreet Shankargal, and he's been a very good friend of mine. Before I introduce the speaker, I wanted to quickly highlight a couple of housekeeping instructions. Number one, please do keep your questions short and concise, conceptual level at the Q&A box. Don't put it to all panelists. We don't look at the panelist questions, put it on the Q&A box. There'll be a survey towards the end of the webinar, if you could please fill in the survey, we would be extremely grateful. And also individually, if you can write to us speakers that you like, we would be able to get those speakers on board. Thirdly, the presentation for today's webinar, Supreet has been extremely kind to actually say that this presentation material is available. I don't know if you've looked at the short guide to options and futures that is sent to you. In addition, for members, I've sent two links. Harshad would have sent two links as refresher readings. Do take a look. Now, about Supreet. He's probably, arguably, the youngest hedge fund managers I've known, and who started equity hedge fund at a young age of 23 and also sold it off to a Japanese company. Currently is managing multi-million dollars in family money, sits out of Dublin, has been a great friend. And without further ado, I would pass it on to Supreet. We've got one hour time today for the webinar, but we might exceed it a little bit. Let's see. Thank you very much. I hope you enjoy the second session. Over to you, Supreet.
Thanks, Srinivas. Thanks for the kind intro. And hello, everyone. I hope you're all having a good day, whichever part of the world you're logging in from. And I presume everybody is safe, given that you're on this webinar. Otherwise, you wouldn't be on this webinar. And to start off the webinar, it's all about hedge fund strategies and derivatives trading. Now, when we hear hedge funds make huge headlines for a variety of reasons, be it eye-popping returns generated by some of the hedge funds, or be it the huge fees charged by some of the hedge fund managers. Now, what enables hedge funds to do things differently? It could be a variety of reasons, like being able to trade flexibly, being able to go short on certain assets, being able to use leverage, being able to trade different types of asset classes. And also hedge funds have access to instruments which is not available to general investors and fund managers, like the likes of credit default swaps, which you can use to bet against mortgage, and other over-the-counter derivative products. But in today's webinar, I like to keep things simple by talking about those strategies which are used by hedge funds, which also can be used by everyday traders and investors. Now let's begin the webinar, and this is how we will be going about our webinar. We'll be trying to cover all these topics in a matter of 30 to 35 minutes. I want to keep things crisp and clear. So I will not be going too much into the details on the numbers part, because I don't want this presentation to become dry. There is an Excel sheet everybody would have received. You can go look into the Excel sheet after the webinar to see how the calculations have been arrived at. So without further wasting time, I would start off on how you can use options for hedging and speculation. Now, everybody knows what an option is. I'm pretty sure if you're all taking interest in joining this webinar, you would know the basics of what an option is. Now, when it comes to everything in life, we have insurance for everything like your house, life, health. You even have insurance for phone these days. But when it comes to investing and trading, how many of us have an insurance to protect our portfolio from unknown losses? Not many. Even the ones from finance professionals who know how to use options as a hedging instrument rarely use options to hedge their own portfolios. Now, there are two parts to this topic. One is how to use options for hedging, and second is how to use options as a speculative instrument. Like we will start off with how to use options as a hedging instrument. Now, I have taken a scenario where you're a long-term investor and you like to hold shares for a particular period of time. Now, this timeline could be different for different people. For the purposes of this example, I have taken the company, which is Infosys Limited. Infosys Limited is a technology company which is listed in NASDAQ, as well as in Indian stock exchanges in the NSE and the BSE. Now, this is a company which is a kind of a stable company. It is not too volatile. It's a low beta stock. So let's say you ended up buying 12,000 shares of this company at the start of the year. Now, as of date in the May, you're down probably about 8 to 8.3%. Now, let's say you say, I don't care. I'm going to hold this for a long term. And I still know that the company is solid and I'm going to continue to holding. Fair enough. But how about if I tell you there are ways where you can earn an extra income out of this holding without taking further risk, or you can say reduce the cost of your holding by a certain percentage. I'm pretty sure everybody knows what a covered call is. For those of you who don't know the covered call, it's basically you're selling a call option on the shares that you already own. So what is a call option? When you buy a call option, it gives you the right to buy a share at a particular price. Now, when I sell a call option, it means I'm ready to give up my shares if the share were to cross that particular strike price. Now, since I bought Infosys shares in this example, let's say 730 rupees, let's say I sell a 800 strike price call option, because why am I selling an 800 strike price call option? Because let's say in any given month, I know for a fact from having done my research before that the particular share may not move more than 5 to 6% in any given month. Now, if it were to go anything beyond 5 to 10%, I'm happy to give up my shares and book a profit at say 10%. It's like more of an opportunity loss. If Infosys were to go at say end at 900 by the end of the month, your gains may be capped at 800 plus whatever premium you receive by selling this call option. Now, what you're trying to do here is you're trying to reduce your cost of holding by whatever premium you receive every month. Now, there is no risk involved in doing this strategy because you already hold the shares. So the worst case scenario is if it crosses 800, you give up your holding of shares at 800, which is still a healthy profit of 9%. Now, this is not a strategy where you reduce it's not a way to cut your losses. It's more of a way to cut your volatility of the portfolio. Or you can consider this as an extra income generating strategy, because you do this month on month. Around 80 to 90% of the time, your options will expire worthless. So you end up taking the premium, and that premium generally is close to 1 to 2% of your portfolio every month. Now, I won't go into the Excel and I won't go into this example of how we have arrived at this figure. You can look at the Excel sheet post this webinar as to how we have arrived at this figure. So by doing this on a month-on-month basis from January to say till May, by selling covered call on Infosys, I managed to reduce the loss by 8%, because by way of writing premiums, I've received close to 8% of the stock value. So instead of having an 8.3% loss on your portfolio, you're just having a loss of minus 0.3%. Now you can continue to do this month in, month out, till you decide to say, oh, I want to sell my Infosys shares right now. I'm ready to take. It's an additional profit apart from the profit in the shares itself. Now, this helps you reduce your portfolio volatility. Now, we will see situations where to avoid writing covered calls. I will probably cover this towards the end of the slide, where it'll be more of an interactive Q&A session. Now let's go on to the next strategy, which is another common strategy where you end up buying insurance on your portfolio, which is by way of buying a put option. Now, what is a put option? A put option gives you the right to sell the particular stock at a particular price if it were to go below that price. Now, a good example in life is a life insurance or a health insurance. If something happens to your life, the insurance company pays out a large payout, depending on what your insurance contract is. So when it comes to stock market, you have a variety of prices where you can say, I want to cut my risk covered from this particular price. Now, taking the earlier example of Infosys itself, let's say your price, you bought it around 730. Now you want to protect yourself from any downside in this particular stock, particularly in a situation like what we are having in front of us today with the coronavirus induced panic across the world markets. Portfolio insurance is more important than ever before. Now, the trick here is to pay less premiums on the insurance that you buy for your portfolio. Now, when you buy a put option, the premium depends on whether it's closer to the money or it's near the money. Basically, is if it is closer to the present market price, the premiums tends to be higher. Now, if you buy the options which are closer to the money, you end up paying a huge premium, especially when market has already gone down, the premiums tend to be higher. So the thing here is to buy a put option which is far out of money, which is say keep a 20%, 15 to 20% gap from where the present market price is, and then buy a put option. Why? Because you want to pay less premium as possible. Because when you buy put options to cover your risk, you're not here to make money on those put options. You're here to make sure that your portfolio does not lose significant amount of money in case we have another crisis of some sort. We don't know. Today it's coronavirus, tomorrow it could be climate crisis or anything else. The thing is, it could also be things like company going out of business because of bad management or taking on too much loan and they can't pay. The thing is, like any activity in life, when you do invest or trade, you have to take a certain amount of risk. You can't say, I bought something at 700, I want my risk covered right from the moment if the stock falls below 700. You need to have a certain amount of risk that you can take. In this case, maybe it is 600. Say, I'm ready to take risk till 600 because I have a long-term holding view. But if something were to happen drastically, I want my risk covered from 600. So when you buy these put options, it will pay you out if for any given month, in any time, if it goes below 600 drastically, you will get covered on your portfolio. Now we will see what type of put options to buy and where to buy it. Again, I'm going to discuss that towards the end of the slides. Now, the learning from this is covered call is ideal when you have a particular target that where you want to sell your shares. It could be, say you bought at 700 and you say, I'm happy to get rid of my shares at 800 or 850 or 900. You can keep selling those call options. Now, you don't do covered call writing in a particularly strong bull market when everything is going up day in, day out, and we have no other particular major news event playing out. You avoid writing covered call. Or if you still want to go ahead, write far out of the money call options on your stock. Now, again, when you buy put options, make sure the premium is as less as possible. Now, next is the favorite for most people on how to use options for trading. Now, everybody wants to use options to trading, those who know how to trade options, because the amount of premium that you pay is very less. And you can buy an option. If you buy a call option, you're guessing that the market may go up. If you buy a put option, if you're thinking that the market may go down. The thing is, why buy options? Limited loss. When you only lose whatever premium you pay and you have unlimited profit, it's not surprise for option investments or option trades to make money as much as like 1,000% to 5,000% on a single trade. A good example in the recent past is hedge fund manager Bill Ackman buying credit default swaps before the coronavirus. He bought somewhere the insurance around the month of February. He bought credit default swaps for about 26 million. And when at the height of the coronavirus panic, sometime during March, he was paid out $2 billion for that particular trade. He only paid 25 million and he got paid out 2 billion. And that percentage is quite a big percentage. Now, the thing is, options give you the leverage with less money. It's like sometimes you can have leverage of buying equivalent to 100 shares for as less as something like $5 to $6, which is the coffee you would pay for in a Starbucks. Now, when do you buy options? You buy options when you're expecting a particularly favorable movement. It could be either on the upside or it could be on the downside. Now, if you want to limit risk on speculation before key events, like say if you want to bet on things like earnings season, you want to play an earnings season, although it's not recommended, and you still want to make some money and you say, I want to take a chance, you use options because you only lose a small amount of money compared to say if you were to buy using the stock itself or in the future. Now, when you buy options, you're aiming for a home run. You're not here to make 5% or 10% return on your option trade. You want 100% return, 1,000% return, or even 5,000 to 10,000% kind of return. Now, how do you achieve such trades where it gives you that kind of return? Not every trade is going to give you that. More than 90% of your buying option trade is going to lose money. The thing is to have enough of those options when it makes the home run is to hold on to it. Now, the key fact is you don't buy options when the VIX index is high. One is the VIX index high when the fear in the market is very high, especially right now. That in the month of March, when the world markets collapsed around the world, the VIX went to as high as 80, and you don't buy options during such a scenario because the premiums tend to be extremely expensive. An example is when you have after an earthquake insurance becomes very expensive. The thing is to buy options when the VIX is low. Now, I have taken a scenario here where I've example is where you're playing an earnings season. You're in this again, I'm keep sticking to Infosys example. Instead of just going and buying the Infosys shares before they announce the results, it could end up it could have a huge loss if it doesn't work out in your favor. So the thing is to bet using options. You can either buy a call if you think they're going to perform better than expected, or you can buy a put option if you think they're not going to perform better than expected. The thing is, if you get it wrong, you lose only the premium that you pay. In this case, say I've taken example where you pay only 25 points to buy a call option on the Infosys. If things were to go wrong and if the stock did drop 10%, instead of losing 70 to 80 points, it's better to lose 25 points than lose 70 points by playing. The thing is, in this case, by seeing the Infosys did perform about 5% after the results was announced. Now, the 5% move in the stock itself has generated a 68% move in the option. And again, like I said, this strategy will not work if the VIX is very high. Now, buying secrets. When do you buy options? It could be either put option or it could be call option. The thing is to buy expiring options, because when you get closer to expiry, when you have 2 or 3 days left to expiry, the time value on the option tends to be very low. So you end up paying a small premium. And generally during expiry, the market tends to have a big movement. It could be on the upside or it could be on the downside. And particularly in situations like today, where we have uncertainty almost on a day-to-day basis, you can still buy options cheap when it's expiring, and you can have a big payout if it works out in your favor. Now, I have taken some examples of live trades on how to buy options. For those who are new to options trading and have never traded options before in live, I've taken some live examples of the option itself, and I have put that towards the end. I will show you how those option trades have turned out. Now, when you buy options, you want volatility, you want surprise movements, you want things to move in your favor. So you don't buy options on things which don't move. You want the thing to be volatile. It could be companies which tend to be very susceptible to the economic factors. And it could also be companies like pharma companies, whose drug reviews pending with the FDA, and news could make it a make or break event for the stock. So you buy options on volatile assets. Now, this strategy is called as a straddle. Straddle involves buying a call option and a put option at the same time. Now, what is a straddle? Why do you use a strategy called as a straddle? You want to play moments like national election where you don't know what the outcome of the results could be, but whatever the outcome is, it tends to be a big volatile moment. Say, for example, we have a US election coming. If say Republicans or Donald Trump were to win, let's say the market goes up again because they know that Donald Trump is business friendly. If the Democrats were to win, let's say the markets may end up going down significantly. Now, for purpose of this, the thing is when you buy both call and put option, you want the markets to move extremely in big way. It could be on the upside or it could be on the downside. You don't have to care, because when you play, you're sure to win as long as you have a big movement on whichever side it is going to be. Now, for the purposes of this example, I have taken 2014 Indian elections where Narendra Modi ended up winning. Let's say if Narendra Modi had not won, markets might have gone down significantly. But in this case, he did go win. I'm not going to go too much into the numbers. You can see what the numbers are from the Excel sheet. The thing is, when you buy both call and put option on the same index, you want the index or the index to move more than what the premium you are paid. In this case, it's 490 points, which is roughly about 7.3% of the index back in 2014. So as long as the market moves more than 7.3%, it could be on the upside or it could be on the downside, you will make your money. And as you can see from the Excel here, and you can see in your Excel sheets, the markets went up significantly and you ended up making about 60% return on this trade. The thing is, when you buy a straddle, you need to do this at least 10 to 15 days prior to the event itself. The reason is, as more and more news starts coming into the market, like opinion polls, or it could be interviews or surveys and other things, the markets tend to discount these things and market starts to go in that particular point. So the thing is to give at least 10 to 15 days gap before you do this. And the main important thing is the amount of premium you pay, because you need to make a fact check as to whether it looks realistic enough for the premium that you're paid, whether the market will move more than 7 to 8%. The thing is, you can do historical analysis before you try this to see if whether such a scenario would work. Again, you need to ensure that the VIX is not too high when you do this, because you're buying options here. Now, the best part is when it comes to shorting or selling the option. Now, when you sell options, you get to be the bank, or you get to be the casino, or being the insurance company. Like, unlike in real world where you cannot back out of your bets that already made, in the stock markets, you can always exit the insurance that you have wrote by buying back the options. I will tell you, for those who have never traded options and who know options only from an academic point of view by way of your CFA guide coursework or any other academic program, I will show how the options are traded and how the options are quoted. Towards the end, there's a video. I'm going to show the video how the options are traded with a live trade. Now, when you sell option, unlike when you buy options, you have an unlimited profit. But when you sell option, you have unlimited loss and a limited profit. Now, why would anybody want to do a trade with unlimited losses? The thing is, when you sell options, you're betting, you are the house, you're betting that the certain event will not happen. And more often than not, 80 to 90% probability, you can take trades with 80 to 90% probability of you getting the money. The thing is, here you're making the limited amount of profit. You are almost sure that you're going to make these profits when you sell an option. So when do you sell an option? When it's a fairly stable market, or when you know the direction of the market. Right now, nobody knows the direction of the market, but there will be situation once this all eases out, you will know what the direction is. It's either a bull market or it's a bear market where the prices are falling continuously, in which case you can sell. If it's a bullish market, you can sell put options. If it's a bearish market, you sell call options. And the thing is, do not sell option when there's a big policy announcement, like a Federal Reserve announcement or any other major government announcement, because you don't know what the movements could be. There could be surprise for everybody, and you can't guess what the surprise would be. So no, don't sell options when there's a particular national event that is going to be taking place. And also, when you sell options, you just don't sell any amount of options. You need to ensure that the leverage that you're taking when you sell options, you're not overexposed. So you need to have sufficient funds in the back to ensure that you can have enough resources to go and buy or short the stock if things were to go wrong. And we will see some of the situation where things can go wrong. I will also share say how you can avoid those situations by using certain risk management principles. And again, I hope it will be more of an interactive session rather than me just talking out of slides. Now let's move on to the next slide. Naked call selling. Naked call selling is nothing but selling call options when you don't own any shares. So basically, you're just selling call options. The risk here is when you sell a call option, if the market were to go over that price, you end up making a loss. So in this case, the reason why I've sold a call option is I think after the recent crash of 30 to 40%, markets have recovered fairly quickly in the last few days. And I think, like many people think, that maybe this run is done and maybe there's not much upside left. And when you think there's not much upside left, you want to, instead of going and shorting the index or the stock, you're better off selling a call option because it cuts your risk by a certain percentage point. When you buy a call option, it means you have the right to buy at a particular price. When you sell a call option, it means you take on the risk the moment if the price crosses that strike price. In this case, I've taken S&P 500 as an example, S&P 500 index of the United States. So in this case, I have sold a 3,100 call option on S&P 500 when the index was at 2930. Now that's approximately about 5 to 6% away from the present market when I sold this. When I sell, the maximum profit I make is whatever the premium I receive by selling this option, which in this case is $22,000. And I'm assuming I have a 1 million capital. So when I sell this premium, when I get this premium of 22,000, my maximum profit is 22,000, which is roughly about 2.2% of my capital. Now I have to sit with this option till 19th of June, which is when this option will expire. Now, I don't care as long as the market does not cross above 3,100, I end up making my 22,000 no matter what. Like you can see from the Excel, you can probably check the Excel sheet in much detailed figure as to how the margins and everything has been calculated. I won't go too much into the numbers, but like you can see here, you only start making a loss once the market crosses 3,115. Till then, as long as it closes below 3,115, you end up making your $22,000. Now, for the purposes of this webinar, I did take a real trade. I took this trade on 8th of May. I sold an option for $15.17, and I sold about 1,500 quantity. Now, this makes my leverage of my portfolio as to roughly about 4 million. I have 1 million in capital, so my leverage is about 4 times. And as of date, the markets are going up slightly, so my premiums are higher than where I sold. So I have a mark-to-market profit loss. But as long as I'm not worried, because as long as the index does not close above 3,100, I make my 22,000 when it closes on 19th of June. Now, there are ways where this could go wrong, and I will show how you can cover yourself or restrict those losses. There are a number of things that you can do. We have seen what a covered call is. If you want, say the market were edging closer to the option where you have sold, in this case, it's 3,100. Let's say around 3,050, you start worrying that it may cross above 3,100. Then what you do in that case is you buy at the future. So this becomes more of like a covered call scenario. So it still doesn't stop you from making loss if things go wrong again by going down, but it cuts your loss. Or you can say, I'm fairly convinced that this is not going to go above 3,100. If it does, no problem, I will go and short the index. There are many ways you can do it. We'll discuss all the risk management principle and how you can get out of the loss-making position if this goes into loss a bit later in the slides. Now, naked put writing. This is my favorite, and this is a very conservative way to buy stocks. This strategy is used by many investors like Warren Buffett. So in this case, you have the capital to buy a particular stock, but say you don't want to buy it today because you don't want to buy it at the price which is being quoted today. Some of you may have missed the rally which has taken place in the last few days. Let's say you want to buy an XYZ company share at $150, and maybe it is quoting at $70 today. You don't want to buy it at 70, but at the same time, you want to put your capital to use. How do you do that? You write put option. When you buy put option, it means you have the right to sell your share at the particular price. When you sell a put option, it's equivalent to you buying the share at that particular price if it were to go below that price. So, and let's say you have a $1 million capital with you. and you don't want to buy S&P 500 index at today's price, but you are comfortable, say, buying at 2725. And right now, when I wrote this option, the S&P 500 was around 2934. So that's roughly 7% below the price it was quoting in the market. Let's say I'm comfortable buying the index at 2725, but at the same time, I don't want to just sit idle with my capital. I want to put it to use. So in this case, I'm not going to use any leverage. So I'm going to buy, I'm going to sell enough put options, which will make my portfolio exposure to just 1 million. So if things go wrong, if it goes below 2725, I will go and buy index at 2725. And if it does not go to 2725, I end up making $12,000 on my capital, which is roughly about 1.2% per month. And you can do this every month, and there's nothing stopping you from going and writing put options every month. And 12% to 11% to 12% return on the year is a very good return, no matter what, for not doing anything. As long as the market stays about 2725, you end up making your premium of 12,000 in this case. Now, I'm not going to go into the details of this example. I've taken the trade again on 8th of May. I sold it at $38. Right now it's at $30. I'm already making $3,000 profit. If I want, I can just go close this. I think I'm gonna wait it out because I know I have enough capital to go buy it if it were to go below 2725. The reason here is I don't think it is gonna go to 2725. I wanna make my entire $38 because that's a good 1.2% return. I'm just happy to sit and do nothing. As you can see, it doesn't matter where the index goes, you'll make your $12,000 as long as it stays above 2725, 2690, which is your break-even capital price. Now, this is the learning outcomes. You buy expiring options, you buy options on index or stock which is volatile, and you sell options, you sell call options when you know that the market has kind of reached a top kind of a scenario or it's kind of become overheated. And do not sell options beyond 1 month expiry. There are a lot of options like a daily option, weekly option, monthly options, like 2 months, 3 month option. The thing is to, when you sell a 1 month option, because time is your friend. The more the time passes, the premium keeps going down every day. Now, how do you trade in an event-based and a non-event-based scenarios? Everybody will be having this question in mind. We are facing a challenging situation today. The markets went down drastically in the month of March, and now yes, markets are almost seem to recover everything. Now, you're worried that it may not hold on because you think the bad news is still yet to come. Like in the case of there could be more bankruptcies, there could be scenarios where the airlines go bankrupt, etc. Now, how do you trade? You're not fully convinced that this is a rally which is going to stay. At the same time, you're not sure whether the market will go down. How do you trade in such a situation? Because even if you have a conviction, say, I think the airlines are going to go out of business, I'm going to go short airline stocks. It's not as simple as that, because you've seen in the last few days that the Federal Reserve has been stepping up in a big way, printing trillions and trillions of dollars and pumping into the market, which is why the stock markets around the world have seemed to recover. Now, do you fight the Fed and go short, or you don't fight the Fed and you just go buy the stocks? Let's say in a scenario where you want to buy the stock or buy the future or buy the index, and how do you protect yourself from a significant downside? And you have seen the previous examples of using covered call scenario. And how about I say you can use a kind of a covered call scenario where you're protected significantly on the downside. Like I said from the previous slides, when the volatility and the fear in the market is high, the premiums on your options tend to be very big. Now, most of you know what an in-the-money option is. When you have deep in-the-money call option, it's like, say, right now the index S&P 500 is at, say, 2,900. Now, when you buy a 2,500 call option on S&P 500, it gives you a right to buy at 2,500. Now, why would anybody give you this index at 2,500 when today the price of it is at 2,900? Answer is clear. Nobody is going to give you that. It will be priced more than 400 points, which because it gives you the right to buy at 2,500. The index today is at 2,900. It will be priced more than 400 points. Now, you use a scenario like today because the deep in the money options have huge premiums. at the same time, it has a bit of a time value left because the volatility is very high at the moment. So here, what you're trying to achieve by the strategy is you buy the future and you sell deep in the money call option. Now, what you're trying to do is you want to achieve a fixed upside, but at the same time, you want to be protected for a significant downside because you don't know whether this market will continue to go up or continue to go down. And because the downside risk is pretty high. In this case, I've bought S&P 500 future at 2852 and I've sold 2550 call option. By selling this option, I've received $332 per share. So what it does here is I have a significant downside protection because as long as S&P 500 does not go below 300 points, I'm well protected. I will continue to make money. If today, let's say in the end of the month, if S&P 500 were to end at 2852 itself, you have to return $300, but you get to keep the $32, which is why my maximum profit is $45,000. This from your Excel sheet, you'll see I've bought 1,500 quantity. So 1,500 into 32 is $45,000 profit. So irrespective of where the S&P 500 ends on the upside, I will continue to make 45,000. And it gives me downside protection all the way till 2519 because I have the premium of $300. Now, as long as S&P 500 ends anywhere between 2850 or 2500, I still make my money. Now, that's a wonderful strategy where you have significant downside protection, but you have a limited upside. 45,000 is not a bad profit for, say, 1 million capital, which is for 4.5% return for a month, which is a fantastic return in any month for that matter. Now, I've taken the real trade. I bought S&P 500 in the future. I bought it 2854. Right now, the markets have gone up. I'm seeing a profit of $139,000 euros here. And I've sold 2550 call at 332. Although it says it's a loss of 120 because the option still has time of 20 to 25 days left. And right now I'm making about $19,000, but I still want to make my $45,000. So I will hold on to this till the end of the month, or the end of the expiry. In this case, it's the 19th of June. This is a wonderful strategy that you can do in volatile times because the premiums tend to be high. Now, you don't necessarily have to sell 2550 call. You can go and sell a 2200 call, or you can sell a 2100 call and have a more significant downside protection. But the thing is, the lower you go, the profits tend to go down slightly because you're getting more protection. In normal times, maybe you will not have so much premium for a deep in the money call options because there will be very little difference between what is there in the present market and the option price. We will again look at ways of using the strategy towards the end. Trading in non-event based scenarios, I don't have to tell you how to trade in non-event based scenarios because everybody is a pro in bull market. Whatever you buy tends to go up. And when the situation is clear, you know what the direction of the market is, you can do directional trades. You can go buy the stock or buy the future, or you can do covered call, you can sell naked put options, and you can do all sorts of trades. I'm not going to cover much on to how you can trade into non-event based scenarios. Now, how do you hedge risky future bets with options when things go wrong? From the picture, from the meme here, you can see that it's an example where you ended up buying oil at $0 thinking that oil can't go any lower because generally all the assets tend to stay at it doesn't go below $0. But the thing is, we were proved wrong. For the first time in the history, oil went into negative price. So for people who bought at $0 thinking it won't go down, were having a huge shock of their life when it ended at minus $37. Now, there were situations, I can tell you the real news, where a broker called Interactive Brokers ended up having a $110 million loss because its system had a snag. It could not show price below zero. It could not show negative prices. So what people kept doing is they kept buying futures at $0. And when they didn't know what the price was on the oil, and when it was at minus 37, the system was showing at $0. So there was an example of a guy in Canada who bought oil for what, $75,000 approximately. And at the end of the day, he had a huge shock of his life, and he has had a margin call of more than $1 million. Luckily, the broker decided to take the fall for this. But what do you do in the situations like what we are facing today when you buy something and you have a huge margin call because there was a huge gap down opening when after you bought it? We'll see what we can do in such situations. Also, another good example I want to tell you about a particular hedge fund in London. I know for a fact from a trader, she ended up buying put options on oil at around when for zero strike price oil. So basically, she would be compensated if oil price went below zero. She paid about £30,000 to buy these options. At the end of the day, when the oil was at minus 37 or minus 30 something, she had a huge payout of £120 million from just one trade. She paid 25 to 30,000 pounds for this option and had a huge payout of 130 million. Now, such trades are possible with options, and we'll see what kind of options to buy towards the end of this webinar. Now, what do you do in such situations? Number of things. The best scenario is always to cut your loss, because there's nothing better than a scenario where you just cut your loss and reverse your position. And if you can't cut your position, and if you still want to stick with your conviction that it is going to go, eventually it is going to go back up, you can do things like covered call, selling a call option on it, like all the things you've already seen. Or you can sell a deep in the money call options like in the example seen before. But always the best situation is to just cut your loss and move on. There's nothing better than such scenarios. Now, coming towards the last few slides of this webinar, portfolio structuring. What do you do? How do you have mix of non-cash based portfolio collateral in your portfolio? For example, you could be an investor who just likes to buy certain ETFs or shares and keeps it in the portfolio because your job is not to trade every day. So you could have a mix of cash, you could have a mix of stocks and commodities or bonds. For the purposes of this example, I've assumed that you have a mixture of index ETFs and commodity ETFs and a bit of cash. Now, let's say you were stuck in this like everybody else and you ended up making a loss of about 30 to 33% on your portfolio. Now, how about I say you can have the same mix and slightly outperform your this portfolio itself by a few percentage points? How do you do that? So instead of going and buying all these ETFs by paying cash, if I say use your capital to buy something like a liquid ETF. What is a liquid ETF? A liquid ETF basically invests in government security like treasury bills, etc., which gives you a fixed percentage of return. Now, if you happen to be in a country like India, you're fortunate enough to get treasury yields of about 5 to 6% on these liquid ETFs. So I will tell you for countries where you can't buy liquid ETFs, I'll tell you what you can do. But say if you were in India, I would go and buy about 70 to 90% of my capital to go and buy these liquid ETFs, and then use that ETF to be used as a pledge collateral to get my margins. So instead of going and buying the ETFs, I would say go and buy the same index in using futures. Now you can go, when you pledge your collateral, when you use your liquid ETFs, the margin broker gives you a margin to use it to trade against futures. So you can go and buy the same mixture and have a better return. Like you can see from the Excel sheet, I'm not going to go into numbers. Your index ETFs would have made about 6% return. In this case, I have 90% of my capital allocated to the liquid ETF. So it ended up giving me 5.4% return on my portfolio. Now, the rest of the portfolio had a loss, but instead of having minus 34% loss, I have reduced my loss to minus 29%. Now, by just doing a simple thing like going and buying liquid ETFs. Now, for countries where you don't have the opportunity to buy a liquid ETF, which gives you that kind of return, you can buy other ETFs like gold. And I understand when you buy gold ETFs, you have a leverage in your portfolio because it tends to be more than one. Now, in my own personal portfolio in India, I have gold ETFs. I used majority of my capital to buy gold, and I've used this as a pledge. And luckily for me, the gold has gone up about 30 to 40% since the time I bought. So if I have a loss in my portfolio, my gold profits would have set off my losses, or if I have profits in both, it's just an additional bonus. Now you can either use gold ETF to do this, or you can use a fairly low beta stocks steady stocks which don't go down much or which don't go up much to use as a collateral and then go buy whatever stocks and futures you wanted to buy anyway. Now, what is leverage future trading and non-leverage future trading? You might be wondering, what the hell is this? The thing is, non-leverage future is as simple as what you've already seen. Instead of buying stock, you can just go buy futures and put rest of the money into an ETF, which gives you some kind of return. Now, I can't tell you how to make money using future trading. That strategy could be different for different people. I could go short on the particular stock. You could go long. Both of us may end up making money because both of us have different timelines and different strategies in mind. Now, when you go trade futures, the most important thing is risk management and discipline. The thing is, you need to protect your capital. You need to have enough if things go wrong. You don't want to be stuck in a situation where you were right about your particular conviction, but you got hit on a margin call. You don't have any more money to support your losses. Let's say you have a view that airlines are going to go down. Let me go on short airline stocks. You could be very well right, but if you say put all your capital and take huge leverage and go short airline stocks, and say you ended up, the airlines prices and stock prices ended up going against your prices, you have a huge margin loss. And after you got washed out of your portfolio, let's say the week immediately after that, the airline stock collapsed. Even though the event did happen, you don't make money because you got washed out, because you were heavily leveraged and you don't have any more money to take the trade anymore. So a couple of risk management strategy is, do not have leverage of more than 4 times, because 4 times itself is a lot. I would advise people to keep it under 4, because you don't want to take a situation where you have a big movement and you end up getting washed out. Now, when you when you go short on a particular stock, risk management is very important. You need to stick to a plan. You need to have a certain timeline. If it does not work in this particular time, I'm going to get out of the trade, because usually you start showing signal that your trade is going to work, because when you go short and if it does not react in that particular direction that you want it to go, you know it's not going to work. So it's better to have stop loss. You need to have strict stop loss and get out of your position if it does not work. Now, all of us, when we start trading, we have a tendency to hold on to our losers, because you don't want to get rid of your pause. You don't want to book your loss. You want to keep holding. Keep the winners, get rid of your losers in the portfolio. And you need to look for data in unusual of the places, because news is no longer the place where, because news, everybody has the same news, and there's no more edge by reading news and taking a trade. Now you can look for data in unusual of the places like Twitter news feeds, social media, Google search analytics, and different kind of alternate media sources. Now, when you are playing a volatile event, you buy the rumor and sell on the news. You don't hold on to stocks where you just bought because there was a particularly good news in the favor. It could be things like where companies are coming out with announcements saying their COVID-19 drug is showing signs, and you want to play. You don't hold on to this long enough. You just buy and sell as fast as you can. And there are a couple of more risk management strategies that we can look onto. And these are some of the good sources of information. You don't have to, not everybody has access to Reuters and Bloomberg Terminal. You can still log on to Bloomberg and CNBC or Reuters News app. Investing.com is a good place to start for all your investment related activities and news flow. And I also share my screen on a particularly good website where you can use it to track different financial information. Now, I promise that I will show how options are traded with a live trade. I will just show in the next slide how options are traded. This is, as of yesterday, this is an S&P 500 options. You can see call options on your left, and you can see put options on your right. Just the video is loading. Doesn't matter, like you can see, call options for the same strike price of 2950, call options are priced more than put options. I'll tell you the reason why call options are priced more than put options in any given market. It's because the cost of holding a share is generally more expensive than shorting the price. But put options tend to be the better options in terms of delivering results. Why is that? Because when a stock price goes up, it's like climbing the steps of Empire State Building. But when stock prices start coming down, it's like falling from Empire State Building. It's just drastic. The reason for this is institutions, because there are lots of fund companies, there are mutual funds, there are ETFs, there are hedge funds holding the same kind of stocks. Now, when there's a bad news hits a particular stock, everybody wants to exit this because nobody wants to have a loss-making stock in their portfolio. So when everybody jump on to sell their stock, there's a panic. And then there's a panic from the general public. They say, I don't want to hold on, I'm going to sell. So when stock prices go down, you have put options shooting through the roof. So put options tend to give a better return in terms of compared to call options, because when the stock prices move up, it's much slower than the fall in the prices. This video is taking time for some reason. I'll leave that, but in this case, I simply ended up buying a call option yesterday because the markets was going up, and I ended up buying, let's say, $23 in a matter of few minutes. And I bought a weekly option because it was just expiring in 2 days. And in a matter of minutes, I ended up selling it at $27.55, and I ended up making a $19,000 profit, which is roughly about 20% of my capital. I ended up putting 100,000 on this trade. I had a $19,000 profit for a matter of few minutes. Now, that's the kind of trades you achieve in options. I will probably get more of your questions, and I would rather answer those in the form of which options to buy, which not to buy, by making it more of an interactive session, and we can open this to Q&A.
Yeah, thank you, Supreet. It was a very comprehensive and lots of data, lots of Greeks. I hope folks who are still hung on, they're still wearing their seat belts. You've given lots of interesting questions. We have limited time, Supreet. There are more than 50 questions on the board, but let me pick some. So what is the risk management software that you use? People don't have access to Bloomberg. Where can they get a look at the Greeks for these options?
Yeah, for people who do not have Bloomberg terminals or sophisticated trading terminals, there are a couple of free resources and also a few paid resources where they can buy certain option analysis softwares. Now, the best one of the lot, and which happens to be free, is one called as Options Oracle. Now, if you go Google, you can find links to download this product, and it covers a wide range of markets from US to Americas to Europe. So you particularly, I used to use this particular software when I started trading back when I was 18 or 19.
So, Supreet, very quickly, how do you keep track? You're entering trades by the minutes and days and weeks. How do you keep track of your net position? What are some of the key ratios that you keep track of? Is it the net delta? Are you tracking the Greeks? Very quick answer.
The thing is, investing, I like to keep things simple, because the further you complicate things, like everything in life, you tend to lose focus on what's really important. Here, you're here to make money, and here at the same time making sure that you don't lose your capital. So mostly when it comes to options and derivatives, I do more of a selling, because I would rather play a probability game rather than buying something and hoping that the event is right. Because when you buy options, like I said before, 90 to 80 to 90% of your trades tend to go wrong. It's not a game for everyone. You need to have staying power, and you need to bet small amount of capital on when you buy options, because when you buy options, most of your options tend to expire worthless 10 out of 12 times. The ones which work, you need to let it run, and you need to have strong risk management strategies, like have a strict stop loss. The stop loss could be based on the stock itself. What is the delta? Now, if an option has a delta of, say, 0.25, for every 1 point rise in the stock, your option tends to rise by 25 points, 25%, which is 0.25 an option. So you need to calculate, say, if the stock were to drop by 5%, I'm out of this option. So you need to calculate of using that delta. You calculate what is that price in option, and you keep that price as a stop loss. And what do you do in trades where options are up 100%, 200%, do you cut your position, or you can't continue to stay on the trade? Have trailing stop loss.
Right.
Because you need to let your winners play. Because
So very quickly, Supreet, what were the two biggest mistakes you made, and how did you get through that? Quick answer if you can.
Like everybody else, you tend to start small. When I started small, I was hungry. I wanted to make as much money as possible in as quick time. So you end up using a lot more leverage when you don't have the capacity to take on such risks. So I was leveraged about 50 times my capital. And when things went wrong, it was a simple thing, like the broker's server went down. So even though my trade was working out in my favor, I could not get out of the trade. So when the system did come back up, I was having a huge loss. I've lost more than my capital. I was actually owing money to the broker. So there was some of those mistakes. I was lucky enough to make these mistakes initially, because you're better off making mistakes as fast as possible and as early as possible, because you don't want to be in a place where you have a huge capital and you want to end up paying a big price later on.
Let me go to some specific questions, Supreet. I am aware we don't have time. So, buying options on stocks and index that are volatile, but are the walls not high then? Quick answer.
Well, like I said, you need to keep watch on walls. If the volatility is very high, the probability of you making a money on that trade is slim. But still, let's say you want to play out that situation. I would say, let's say you want to play a situation where the news is going to be intense. For example, it could be single drug companies whose drug is pending for FDA approval. Classic situation now, because all the companies which are coming out with vaccine programs and other drugs, they're all going to be waiting for FDA approvals. And it could be a make or break for that stock. So even if in some cases where the volatility is high and you still want to take a trade,
right,
the movement would be significant enough.
Great, thanks. So, again, like if you look at the out of the money put options or out of the money call options as well, if you wanted to kind of buy them, how do you decide which one based on the Greeks, or do you use any other parameter? Quick answers, Supreet, so that we can cover lot many questions.
Yeah, the thing is, like I said, the price could be different for different people, because I could be comfortable taking a loss up to a certain level, where somebody else risk appetite may be different. But the idea is to pay as less premium as possible, because 10 out of 12 times you're going to lose money on that trade.
Now imagine you've got a portfolio of 20, 30 stocks, uncorrelated to the index. How does one hedge? Quick answer.
You could, where it's not possible to sell options or buy options on that particular stock, you buy using index options. You calculate the delta of your portfolio and you buy options on using index, because if you can't hedge using the stock options, you buy index options by calculating the beta of your portfolio.
Right. Do you have any view on LEAPS, LEAPS, LEAPS? There are 3-year options offered by exchanges. Quick answer.
Yeah. Do you want to do buying or selling of these?
Let's say buying a LEAP.
The thing is, again, what is the premium that when you buy options, it's all about premium, because what is the premium? If it's significant, don't do it. If it's a small amount, think of it like just buying an insurance of sort on anything and just leave it. It's not going to make a difference to your portfolio.
Right. So now going back to again, your own performance, Supreet. How do you separate luck versus skill? I mean, you're doing this trading all the time. How you keep yourself sane? Are you lucky, you think, or do you have skill? I mean, how do you see through or criticize your own performance? What is it that keeps you going?
Luck is the trades working right from the get-go. Skill is risk management and discipline, because you need to cut your losses. You need to cut trades which don't work. And it's more, you'll get this over time. It's not something that will come naturally, because this will be something which will come after a few years of trading. Because when you start, it's not about luck after a time, because markets are random. I tend to believe markets are random more often than not, because I could go long. I may end up making money. If I don't, let's say I cut my position and go short immediately.
Right. Supreet, one last question. I mean, two last questions actually. One question is easy. I know what books you're reading, but for the sake of our members, if you can mention that. The question before that is there a template for starting out as an options hedger and speculator? Would you be able to share one Excel template maybe for building an options book?
Yeah, I can share after the presentation. I can share a template where people can use that as a template to build their options.
That would be a huge help, because I don't think anybody has done that before, and people will lap up that Excel like anything. If you've got a template, by a experienced trader such as you. And the last question, Supreet, and add some advice for our younger members, as well as more senior people in the industry who've been value investors. We've got a range of investors who I've seen logged in today. So books and advice.
Advice would be keep making mistakes. There's no better way to do this by trading, actually taking live positions. But the thing is, best start with a small capital. And I know if you're starting out small, you will have smaller capital. And the thing is, think, although the money is involved, don't think of it as money, because when you start bringing emotions into this, you will start taking wrong decisions. The thing, it's like a game like any other. It's a very competitive sport. The main thing is everybody may have a different strategy, but what works is discipline and limit your losses, because you need to save your capital no matter what. You need to play it out another day. And as far as books are concerned, there are quite a few books. If you're a beginner, you start with absolute basics, and I started learning about options from an unusual source, from Robert Kiyosaki's book, Retire Young, Retire Rich. That was the first book which hooked me into the options, because he had an example where he started selling put options. And I was fascinated and I got hooked, and that's how I got into trading. And there's also a book by Kenneth Tester. It's called 101 Secrets of Selling Options, Secrets of Trading Option. That's a very good book. And it is still a very good book, even for today's world. The book was written a couple of years ago. It's still a very good book.
Fantastic. Thank you so much, Supreet. We are looking forward to your Excel. We'll share it to the attendees today and those who have registered. Those who have missed out for today, I think it will be there on YouTube and our CFA Institute platform soon. We've got another interesting webinar coming up tomorrow. Don't miss it. Bihari Lal Devra, BD, is going to host for our younger charter pending people, what all opportunities lie for them. So don't miss that out. And see you soon again. Thank you so much. Thank you so much, Supreet, for taking your time out. By the way, Supreet got that speaker just for this webinar. So big thank you to you, Supreet. Thank you again.
No problem. Thanks, Srinivas. Bye. Thank you all for attending the webinar. Thank you.
Copyright 2020. All rights reserved. This program is designed to give accurate and authoritative information in regards to the subject matter covered. It is distributed with the understanding that CFA Institute is not engaged in rendering legal, accounting, tax, investment, or other expert advice. If legal advice or other expert assistance is required, the services of a competent professional should be sought.